Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We are coming to you from the GW School of Business here in Duquesne Hall in Washington, D.C. Hello, everyone, and thanks for watching, and thanks for coming back if you're an existing viewer or listener. Today, we're going to be talking about a company. The company is Oracle. It's a position and a couple of our funds for the GW Investment Institute. And if you've been watching and paying attention, we're going to go through the company using the framework, business management, price valuation, and balance sheet. Now, we rate those 25% each. Remember, not investment advice, entertainment, and informational purposes only here. So let's talk about Oracle. Many of you probably have heard of Oracle, and if you're a business person, maybe you've interacted with Oracle. There's not a lot of really consumer-facing products with this company for individual consumers. It's really more of a business-to-business type of operation, but it supplies software, enterprise software. If you've had sort of a big system, that enterprise system at your job that you've had to interact with, Oracle would be one of those things, the relational databases. And really, this is, one of the foundational pieces from let's say, tens of years ago that people have been using on the enterprise side, and now you're seeing other products come in. So on the business side, Oracle has been early to the game. Larry Ellison, founder of this company, and currently still the chairman and a big shareholder, and we'll talk about that. Early days into the tech world as far as Apple and Oracle and Microsoft as an example, and they're really again on the enterprise system. So it's a good business, and it's been a great business for them. And however, now, things are changing. There's definitely a lot more competition in their space for the enterprise world. So for businesses to do all of their accounting, to track all of their, personnel management, everything to do with like how you would run a business and all the information that you need to take care of, Oracle is in the business of helping companies manage all that information, keep it safe and secure. And really now is moving into the cloud world as well. And if you've been watching on the business side, or you've been listening, Oracle's offering new customers right now. We're in the early part of 2025 in January or early February here, and they're offering customers, half price, 50% off on getting them to move to their cloud. So they're being very aggressive in this world, and lots of people are moving to cloud. And we've talked about, for example, Microsoft in the past about how aggressive they've been and how successful they have been on the cloud, and Google as examples. But Oracle is right there. When you talk about the big players right now in cloud, you have to mention Oracle as sort of part of that crew. Now, they haven't had as much success as Amazon, Microsoft, and Google in the cloud, but you would probably put them fourth right now in that list and say they're having success, and they're definitely now being far more aggressive on getting that business. And so it is a good business, let's say it that way, but it is an old business for the most part, but they are absolutely working to transition the business into something a bit newer. So let's talk about on the business side, what's the revenue look like for Oracle? So you're talking about revenue of $54 billion, but let's do the market cap, $470 billion right now. And so do a data check here on the market cap. So market cap again, $470 billion. So this is a big business, right? This is not a small business. This is not a small company. You're talking about one of the larger companies in the industry. Now let's start going over, what's the business look like on the revenue side? The revenue, 54.9, so basically 55 billion through 11/30, 2024 of last year. So these are big numbers. It's growing pretty slowly though. So more modest growth of the last couple of years, 6%, 6.4%. But you're looking at gross margins of 70%. That is very high. When we've talked about other companies, the only other companies, right, sort of in the high gross margins are other software companies. And so when you think about, possibly with the high prices being charged, you talk about NVIDIA, but you also talk about Visa, which we've talked about before. So these are super high margins and are not enjoyed by everyone, certainly not across industries. This is really more of a software type of business margin, and that's what Oracle enjoys. And when you look down to the net margins, you're talking 22%. So far more, modest, let's say, margins versus a Visa, for example, on the net, which the net margins of Visa are something like 55%. Oracle, right around 20%. They're projected to have their margins go up. And part of that is because of the mix of their businesses. It looks like if they're adding cloud customers, that's a high margin business, especially the incremental customers. If you have that infrastructure build, that's higher margin business that they're potentially adding. And so you could see that their, margin might be going up over time. And we'll talk about that as we talk. Their net margins can go up over time. And as we talk about what's happening with respect to their valuation. But again, this is a very large business. It's been, around for decades. It is definitely a business to business player. It has been for a long time. And they're doing generally well. And they're certainly being more aggressive on the business side. So you would probably rate this business, if you just look at sort of where they've been, where they are, the margins that they're charging, the growth that they're having in the cloud, is more like a 6 or 7 right now. They're certainly have not been as successful in the cloud business as Amazon or Microsoft or even Google, but definitely, again, they're in that 4th spot and coming on strong, a very significant part of their business and growing, right? And so that's super important. And, something to think about as an investor is, okay, well, this is an older line company versus, let's say, Amazon or Google, and those are not brand new companies either, but, certainly a little bit older than those companies, but, very more of a contemporary of Microsoft. But Microsoft got to the cloud game, I would say more aggressively than Oracle did. So you would put them ahead in that race. But Oracle, again, is making strides. So business, I would say kind of 6 or 7. Now let's jump into the management. So one of the pioneers, let's say, in the early tech world, you're talking about Steve Jobs, you're talking about Bill Gates, and Larry Ellison. You would put right in there with this crew as an emerging figure at that time, running Oracle, and but he's still there. He is still active at the company. He is still the chairman of the company. He is still their chief technology officer and founder, and he owns 41% of the company. And so when you talk about a founder-led company, he's no longer the CEO. The day-to-day CEO is Safra Catz, and Safra has been there also a very long time at the company and was co-CEO at one point, and then in 2019 became the standalone CEO. So you really have a steady group running this business, people that have been there a long time. Ellison, again, remains the chairman of the company, remains the chief technology officer, and remains the single largest shareholder at around 40% of the company. And so when you talk about almost 41% as of the last reporting here, and so still owns a huge slug of a massively public company. Obviously makes him a very wealthy person just on that. But you would say, okay, our incentives are aligned with the management team because such a huge portion of his personal net worth is Oracle stock. And so on the management side, as far as alignment goes, you would say that's very high. As far as the people that have the institutional knowledge of this business, you still have a co-founder that's the chief technology officer and chairman of the company. So you would give high praise there if you thought they were doing a job. And I think Ellison is doing a good job, and Safra Catz, I think, is doing a good job. Maybe part of the criticism or feedback that you would give the management team as an investor, if you had a meeting with them, would be saying, how can you be even more aggressive in competing in these new categories like cloud? And what else is there? Obviously, part of what they're doing, they're trying to be very aggressive. And you heard the announcement possibly around the AI world and this Stargate, initiative from the Trump administration, which they were included in on that. So they're definitely being more aggressive. And I would, encourage them, if you have this conversation with Safra Catz and Ellison, that, to triple down, to quadruple down on this initiative that they're already in. And so clearly they're thinking about this. So the management team seems to have a sense of urgency around AI, around cloud, and they're getting in these, markets more aggressively, let's say, than it seems like they were probably 2 and even 1 year ago. And so you would give them high praise for that. Now, again, they're not growing as much as some of these other businesses. So that would be something that you would say, okay, as a management team, you need to be a lot more focused in on that. But they seem to be making progress. They seem to have the sense of urgency and sense of opportunity that's present right now that they're going after. And so you would give them high marks for that. Again, you would give them high marks for the alignment of incentives because particularly for Ellison, it is a very high stake in the company, 41% approximately. And Safra Catz has been there a long time. And so you would say, okay, well, these people have the institutional knowledge. They seem to have this sense of urgency around the business. and growing the business, and particularly around cloud and AI right now. And again, recently mentioned in this initiative around Stargate. And so, high marks for that. So I'd say 7 or 8 probably on the management team. Now, let's get into the valuation side of this business. So when we talk about the valuation, it's not certainly a cheap business. When you have 70% gross margins, that you're going to probably pay up for that. And the forward PE right now, again, early February, 28 times is the forward PE. So certainly not cheap, but not fully out of line with S&P. So, and we'll get to the balance sheet here. And I think that's part of why you're getting a little bit of the ding on the valuation here. But you wouldn't call this excessively expensive. You would probably say for a software company with 70% gross margins, you would ask, well, at that price, maybe the net margins are not quite as high as an NVIDIA, as a Visa, and they're not. So you're talking, 20 plus net margins. So you would think that the market probably, gives them a lower multiple. And this is, a little closer to in line with the S&P. And so you would say, well, on the valuation side, if you think the S&P is the average, and that's a 5 or a 6, that you would be right on top of this, you would probably say that this is a better business than average, and that this, valuation, this metric, the price earnings multiple for Oracle is likely, slightly better than average. And so that's probably appropriate. And so you would probably give this then maybe a 6 or a 7 on the valuation. So you're not saying like this is a tremendous, buying opportunity at this price. You certainly wouldn't call it cheap, but you absolutely wouldn't say that this is a very expensive company when you're talking about, 28 times. When you're talking, Tesla and you're talking NVIDIA, you're talking much higher valuations. Even for Visa, as an example, even Costco, even Walmart at this point. And so when you look at these valuations, you would say, okay, this is not a terrible valuation. This is not overly expensive. But, what are the things that we need to be concerned about? And we're going to kind of, go back through all of these to talk about, how they fit together. But on the valuation side, I don't think it's overly expensive. Next up, let's get into the balance sheet side here. So why maybe this has this valuation? Well, part of the reason could be that they have, $88 billion of debt, which sounds like a lot because it is for the company. And that's not something that helps you sleep at night. So when you think about other big tech companies that we've talked about before, when you talk about Microsoft, or you talk about Google, or you talk about Apple, these are companies that have big net cash positions. And so they're in a big net debt. They have cash in cash equivalents of 11 billion, 88 billion. So you're talking, let's say, $70+ billion here of net debt on the balance sheet. That does not help us, sleep good at night, right? And so why, to have all this, right? They have levered up to do acquisitions. Now, we didn't talk about that, and we'll bring it back. They've been a highly acquisitive company over the past, and they've been successful at doing that. And so, but what it has done is it's led to quite a lot of debt on the balance sheet. And if you look at the debt, it's certainly gone up, but it looks like it's peaked back in 2023 at 95 billion. And so the debt is coming down. And so when we talk about, and this is why we want to talk, through all of the framework again, is that on the management side, it does seem like that they're taking seriously the idea to reduce this debt. So the cash and cash equivalents has come down from a recent peak in 2021, where you had 46 billion and 87 billion then on the cash in the debt respectively. And now you're at 11 billion and 88 billion, and the debt had actually gone up since then. So the metrics have, I would say, deteriorated, considerably from the 2021 numbers, where you're basically with the same debt and a lot less cash. Now, the differences are, again, acquisitions along the way. And Oracle has known, and I think that is certainly part of their business setup. And when you're buying a company like Oracle, if you have shares of Oracle, if you are thinking about it, some of the things that you have to think about on the business side and the management piece is, it's a highly acquisitive company, and you have to think, is management good at doing these acquisitions? And that's part of that capital allocation. And if you go on to the blog, you can check that out. Have they been good allocators of capital? Well, generally speaking, yes. Not every single acquisition has worked, but when you connect to the balance sheet here, you definitely have a balance sheet that has quite a lot of debt on the balance sheet. And it's not necessarily, again, a thing that's going to help us sleep at night. But when you talk about, okay, well, what's the interest coverage ratio? So let's at least check out that metric as far as, do we have some room here, some margin of error on that front? Well, there's not a ton. You're talking about 4.4 times EBIT to total interest expense, and so that's called the times interest earned, or the interest coverage ratio. And so again, EBIT, earnings before interest and tax, over interest expense. 4.4, that's not, helping us sleep at night. You definitely want to be, in the 10 area plus. And ideally, for a lot of the companies that we talk about and look at that are part of the GW Investment Institute portfolio, you really have a net cash position. And so you're really not even thinking about the interest coverage ratio at all. And if they do have some, modest debt, it's more than serviceable, and they have net cash. And so 4.4 times is quite low. This is something that you should be concerned about as an analyst. It's definitely something that we're concerned about. And again, this is part of the equation with Oracle on the business and the management side, where management has been highly acquisitive over the life of Oracle, but they've been successful with that. They've been able to keep that gross margin up in the 70%, but the net margin's at 22. Now, as I mentioned, coming back to the, what's the projection here? As they get more aggressive in the cloud business, the business side of that may improve. Now, they still then need to, while we're talking about the balance sheet, they absolutely need to improve this metric on the balance sheet. As an investor, you could definitely be far more aggressive, and likely they're going to get a higher multiple. So when you start to connect the dots here, this is something that's a concern. Why you possibly see this metric a little bit lower in the price earnings ratio in the valuation category is because, against, let's say some peers, is because of this, right? They're heavily levered. You think about a Microsoft as an example, they are not, right? Net cash, strength, if you had a market downturn of any kind, you could absolutely see, Amazon, Microsoft, Google picking up market share, using their balance sheet as a source of strength to do that. Oracle, very challenging. If you had a massive downturn in the market, or not even a massive, you had a significant downturn, they already have, 88 billion in debt. They only have the interest coverage ratio of 4.4 times. That's not a great position for them to be in. So if they can continue to pay down that debt, improve the metrics associated with that, get that to 10 times, get that beyond that, may, at some point possibly get into a net cash position again. That would be much better. And that's likely going to then demand much higher multiple. And so just on that piece. And then if you grow the net margin, and again, that would be through growing that cloud business, because that's a high margin business, especially for the next customer, because you're delivering, on that, you have all this operational leverage that you built this infrastructure and you can sell it many times. That's a great business to be in. That's a high margin business. And it's been a high margin business for Amazon and Microsoft and Google, and now again Oracle. Now, what's happening on the AI front? If they're leading on that, maybe they're going to gain a lot of market share around that. So, going back through here again on the business side, an older tech business for sure, as compared to a Google. However, has been thriving, has been very acquisitive. Again, still, very relevant in the market, very aggressive now from management on trying to get into the cloud business or try to get further traction. They're already in that business. Thinking about AI, a sense of urgency. Again, they're at least listed in this Stargate from the new administration. So on the business side, I would say, average to slightly better than average at this point. Software business, 70% gross margins, 20 couple percent net margins, doing better. The management team seems to be quite aggressive into the AI space. Larry Ellison, Safra Katz doing a fantastic job right now. Let's see if that continues. The valuation, 28 times on the price earnings for the forward PE, not fantastic, but certainly not a terrible. And I think part of the reason that that's a little bit lower than some of their, let's say, competitors, you certainly have lesser net margins than a Microsoft or a Visa even, or NVIDIA as examples that we've talked about. But more Microsoft as a comparison. And then on the balance sheet side, I think that's a real concern. Something as an analyst that you have to think about. $88 billion. That's not a fantastic number. 470 billion market cap. 4.4 times interest coverage ratio, EBIT to interest expense, something that you should be concerned about, something that doesn't help you sleep at night. But overall, depending on how you're scoring this company, you're probably putting it in the 6 or 7, 7.5, depending on how you rate each one of those things. But to wrap up here, Oracle, very solid business. Sense of urgency from management, 70% gross margins, 22% net margins. Management trying to, gain market share in the cloud and really trying to position them for AI. So big positives there. Larry Ellison still very much involved. SoftwareCats 2019 CEO. I think they're doing a good job on the valuation, kind of average valuation, something to keep track of. And then when you look at the balance sheet, a source of concern. So you're really rating that much lower, 5 and possibly even lower, maybe a 3 or 4. So again, overall, you're kind of in the 6 or 7 category. Not fantastic. Something to watch. It's in our portfolio. As an analyst, you got to do your own work as a reminder. And so again, informational and entertainment purposes only. Thanks for watching this episode. We'll see you back on the next episode of Market News with Rodney Lake. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.